You go, girl.
Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boisseau with Kevin Casey, and today we are joined by Mark McArdle. Hey, Mark, pay attention.
I was reading my notes.
Whatever. Come on, you're a pro. You don't need those notes, do you? Nah. Oh, my goodness. Good morning, everyone. How are you? It's another glorious day in the mortgage business, but at least we have Mark here. That'll be fun. All right. Just so you know, June is National Homeownership Month. Did you know that per NAR? And I was thinking, I'm like, of course, somebody decides it has to be homeownership, but for LOs, every month is National Homeownership Month. Don't you think? Like, we don't need some holiday. Come on. Come on. All right. So tomorrow we have inflation numbers coming out this week. So that's always fun, especially right now with oil prices through the freaking roof. So tomorrow we have CPI. That'd be Consumer Price Index. We also have mortgage apps and a 10-year auction. As we know, auctions move
Actually, so
market.
wait. Oil prices are not through the freaking roof. The barrel of oil is down to $80 a barrel. I mean, that's like a huge drop.
How far ahead do companies buy oil, Kevin?
I don't buy any oil personally, but I know my gas companies do.
Six
And
months ahead, 6 months ahead. So even if gas prices go down to pre-war levels of 60, whatever it was a barrel, it's going to be a while before that kind of trickles into our inflation number. So on to the next inflation number, which comes Thursday. That'd be PPI, Producer Price Index. We'll also have jobless claims and yet another auction, 30 years this time. And there is news on the street that foreign countries are not buying our treasuries as much, and the Fed is apparently not going to be buying our bonds. So, I mean, our mortgage-backed securities. So, not sure who's going to buy all this paper that's being auctioned off. So, cross your fingers, say a prayer to your favorite deity,
I know
and
who will buy it.
hope for the best. Who? Who?
All these people are about to make freaking boatloads of money off of all the AI companies that are going public.
Oh, really? Oh, you
Yeah.
actually believe all that hype? Do you?
Yeah, I'm seeing it. I mean, it's crazy.
Okay, you might be seeing companies thinking they're going to make a ton of money. But if you really take a dive into what's going on in AI right now, it's
Mhm.
not that. So,
I, 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 I'm just saying, once they go public, there'll be some
oh,
people with money in their pockets, and especially SpaceX,
at
not to
least for a few
mention AI.
minutes until everyone realizes, okay, well, and again, I hope it goes well. Don't get me wrong. I just have some concerns. Mark, do you have any comments on this?
No. I keep
Not,
all my money in a mattress, so it doesn't really matter.
Okay, so if you know Mark like I know Mark, I believe him. I've been threatening him for years to set up a GoFundMe page to pay for
actually, I
him
got a funny
so he
little.
could have it so he could have air conditioning on in his Washington DC condo in the summer, and so he can afford the $59.99 it costs for a premium version of Duolingo. Yeah, so there we go. Kevin, what were you going to say?
Uh, as far as investment wise goes, I had an interesting conversation just because I have a charity that I run, and we have regulators that oversee us. And so part of the charity, we have 10 single room occupancy housing for low income individuals. And the state requires that we keep $40,000 on reserve for emergencies. But we have another charity that we run that we have lots of money just for emergencies. So, like if the elevator didn't work one day and we had to call an elevator repair company, we wouldn't pay them out of the reserve fund for the house. We would just pay it out of our slush fund and then refund our money later. But we had the money that was required by the regulators at the $40,000 in a CD where we were making a grand total of 3% whole. All right. But that 3% whole ended up being like $2,000 a year or some crazy amount. But it was like that helped make our budget work because we're that tight on the budget for this place. And the regulators come down and say, no, 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 you can't have that money in a CD earning interest. It has to be completely liquid. And we're like, but we'll never tap it. Like, we're never going to tap that money. Why would we have to have it in liquid? Oh, no, those are the requirements. So we have to put it into a checking account where we have to pay $25 a month and get no interest basically, or less than that. And so I was dealing with financial advisors about like in a CPA yesterday about this, how do we get around all this stupid stuff? And it was really funny because the financial advisor was saying, yeah, I had another organization and they had $400 million that was in the reserve account. And the same regulators, different regulator agency, but same regulators were requiring that money to be in CDs because, quote unquote, that was a safe place to put the money. And it's like, you do understand FDIC does not insure to $400 million.
Okay, that was a really long story. But your point is well taken that there are some stupid regulations out there
Stupid
that make
regulations, lots
absolutely
of
no
stupid ones.
good financial sense. Holy
Well,
crap. Well,
yeah.
we're going to get to that with regards to the mortgage industry in a minute. But first, we're going to start with some slightly good news. You ready?
Oh, wait. It's really good or slightly good?
I'm going to go with positive. Really
Okay.
good. I'm going to say really good for really, really good. Okay. Existing home sales came out and we are up 3.2% month over month. And they were expecting up 1%. So that's an improvement over what they were thinking it was going to be. So
Wait, what kind of sales were up?
existing home
Existing.
sales.
Existing home sales. Okay, good.
Okay,
Because
the
I heard
fact that
casino
out
sales.
of the three of us on here, this is a surprise to only you. We want to ask what you're doing this morning. Anyway, okay, so annualized sales were below 4 million. Now we're at 4.17 million, which is up 3.2% year over year. April was also revised higher by half a point, which is really good because that means that these numbers for this month would have been even better if not for the fact. Anyway, so that's all good. Inventory, we're at 1.55 million units. That's up 3.3% month over month, up 0.6% year over year, which is normal for May, kids, normal, not some huge inventory glut. And days on the market, 29, down from April's 32, which is good. Sold above list, 25% of properties. This is nationally, so you got to dive into your local numbers, but this is good stuff. First time buyers, 35% of the market, which is the highest since June of 2020. Investors are 14% of the market, which is down a little bit from May 2025. And cash buyers are 25% of the market, down a little bit from the 27% in May of 25. So all in all, it's a positive, right?
Yeah.
Okay, now that you've heard the news, you can vote. Was it good news or really good news?
Good.
You know what? It's
Thank
good
you.
news.
It was good, right? Okay,
Yeah.
so no hyperbole yet. Okay, we've been seeing our jobs numbers get better. So let's start with ADP. Their weekly jobs data for the week ending May 23rd. We're up 29,000 jobs a week, which averages about $120,000 a month. Not dollars, jobs. That's it. Okay. BLS though, last Friday came out and had a whopping 172,000 job gains versus the 85,000 job gains that were expected. So that was something. They also had revisions upward for March and April of 93,000 jobs. That's crazy. The household survey unemployment rate stayed at 4.3, although if you looked at the fractions, it was a little better this month than last month. Anyway, so yeah. The other thing too, though, that's interesting is that if you look at the household service survey, there were a lot of part-time jobs added, like a lot. So we'll see how this holds over the next couple months. But the narrative in the last few months has been jobs are bad, bad, bad. You know, we're losing jobs. There aren't enough job gains. And now we seem to have a little reversal because even though BLS can be a little unpredictable, we're seeing the same thing in other job reports. Yeah, that was the word I was looking for.
Nice.
Reports. Okay, so I watched a little ICE webinar. ICE, most unfortunate name in the mortgage industry at the
You watch
moment.
a webinar on immigration control and
No,
enforcement?
okay, sorry. ICE mortgage technology. So anyway, yeah, thank you. Anyway, so nationally, okay, so let's talk about delinquency, shall we? So nationally, they're good. We're still 40 basis points below pre-pandemic levels. and only up 13 basis points from last year. So, you see these headlines sometimes that say that our delinquency rates, oh my God. Um, and actually early delinquencies are down. So, and even FHA is starting to kind of pull it together, and those are looking a little better as well. So anyway, Mark, anything?
With FHA, there was a sort of an accounting thing. They switched to trials, and so you saw a spike in the 90 plus numbers for delinquency, but it wasn't a real spike. They were just all going through trials, and therefore they looked delinquent. But once the trials convert to a permanent mod, they normalized, and we're already starting to see them normalize. So that's good.
Exactly. So the cures are improving even in with FHA, but what they said was that the FHA was marking files as cured as soon as they entered a plan, and now they're waiting till they complete the plan to call them cured. So again, there are a lot of headlines out there about what a disaster FHA is, and it's not as bad as they have said in recent months. So that was interesting to note, and also very in line with what I was told by someone who was previously with FHA. Um, yes.
It kind of brings to mind something I came across yesterday with a client. So I've helped several clients who were moving into senior housing where they need to come up with the money for the senior housing, i.e. they're buying into the project. And usually they need to come in like with $250,000 or so to buy their particular unit in the senior housing type places.
Those
And
places.
it's never been a problem. It's like, yeah, you don't need any income, nothing. I can just do a bridge loan between your current house into the next house. No problem at all. It's super simple loan, sweet, easy close. And, I close within 2 weeks typically. So I get a client saying, guys, I've moved into senior housing but I need to sell my house. And it was in contract, but it fell out of contract. And now I'm kind of facing a little challenge here. I could be homeless um, at the end of the month if I don't come up with the money for the new senior housing place but it's just a rental. It's not a buying into the place. And I was blown away that the regulations will not allow her to borrow against the departing residence. It was free and
Right.
clear property worth just under $1 million.
Yeah.
But it's her only asset. She has no other assets. She's spent all her other monies down to nothing. And so it's like, wow, this is stupid. But my only solution for her is I'm going to see if I can find a private individual that will lend her the money, because as long as they haven't done more than five in a year, then they're not under the regulations, and that's about the only solution I can come up with for this particular woman who is told has the ability to pay off the loans. She only's looking for $100,000 for God's sakes, and she has $1 million. It's like it's a no-brainer loan.
I know.
And like, wow, the regulators won't let me do this loan. It's all
I've run in
personal.
I've run into that too, and I have another I've heard other LOs who have borrowers who are running the same exact thing. And so it's the unintended consequences of regulation by people who don't understand borrower needs. And so they're kneecapping these poor elderly people, and in particular, private money people do not want to get in trouble. Nobody wants the
Oh yeah,
headline,
my private money
that
lenders won't touch it,
yeah, they're not
but
touching
I
it.
happen to know somebody who's like, oh, hey, if you ever have a situation, like, well, I'm going to give them a call and say, hey, let's get a note written up by a title company and do this bingo bango. But
Well, again, it is, yeah, it's rough. It is rough for people who have a lot of equity who can't access it. And so
yeah,
it's a problem. It's a big problem.
yeah.
And, so again, the intention was good, protect elderly people. And we all know that there have been some abuses, etc. But this, definitive line in the sand makes it very, very difficult to help people when they really need it. So yeah, it's rough.
Absolutely.
Um, I don't know how I don't know about saying that you're gonna do it in front of former CFPB regulator.
I'm just making an introduction. That's all I'm doing.
Oh my God.
I
Yeah,
don't have to, I don't have to get paid on it. I can just help the borrower by just saying, here, go to this person, and they'll lend you the money.
all right. If he doesn't get paid, does that absolve him of any liability, Mark?
No comment. Go
All
talk to the
righty then.
California DFPI.
let's move right along. Well, your former boss, Rohit Chopra, is going to be the head of an agency in California, so we have that to look forward to.
Yep. He's a Californian just like you now.
What?
He's a Californian just like you.
Where did he live before?
He lived he rented. So he
Are
rented an
you
apartment.
effing kidding me? Are
He
you?
rents.
Oh my God. The head of the. Are you?
He doesn't even know how the mortgage system works.
I
No,
don't even have
he rents.
words.
Yeah.
I did not know that. Is that for real?
He rented when he was the head of the CFPB in an apartment down the not too far from here.
Oh my God. That is insane. Okay. I don't know what the heck just happened to my. Okay. Hang on. I'm going to.
Ah, no, that's a good. I wonder if he's renting in California. They don't pay. They probably don't pay him enough to be able to afford a house in California.
Well, California's government salary, and he'll be in Sacramento, right? Is that where
Oh
DFPI
yes,
is
he would
based?
be. Yeah,
Yeah.
yeah. Oh, Sacramento. That's cheap comparatively to the rest of
Cheaper
the.
compared to the Bay, yeah.
Yeah.
I have no words. Okay. I'm just. Oh my God. Like literally, that just stopped me in my tracks. I'm like,
What, that he rents?
I mean, that he rents. I mean, come on. How do you have any idea about anything if you have not gone through the process? I see that it's this at tech concerts pretty regularly
Oh,
where you've got these guys who get up on the stage. You can tell by the way they speak that they have
they've never done a
never
loan
gone through the
themselves.
process. They don't own a house. They don't understand anything. And it's like, why are you are, oh my God, that makes me crazy, Earth.
And it does, like, I mean, I remember when I first met Rich Cordray, the first director, he obviously does have a mortgage and had a house, and he was obsessed with how big the stack was that he had assigned to close. And that was a driving issue for him. Like, how can we reduce the stack? Because I remember this personally as being impossible, and someone should reduce it.
And you didn't reduce it, just FYI,
Well,
Richard.
we learned that the federal government controls like less than a third of it. The states control a third. A third of it is just lawyers covering the banks putting in stuff. So like the huge stack is only this much federal requirements.
I will
And that's
get
why we
this.
have how many pages in the CD and LEs now?
Oh my God, don't
They used
even.
to be one page, and now they're.
Oh my God. We used to have the best good faith estimate. It was so awesome on one
I don't
page.
know. I
I
people are
listen,
back in the old days when we had the HUD one, it
okay.
was so good, it was better.
If I really want to go back to the old days, I'm going to talk about World Savings Loan Package, which was like what, 8 pages.
Beautiful.
It was so great.
Here,
Yeah.
I'll pay this loan back. Thank you very much.
But you know what? Okay, and I'm talking about pre-Washington Mutual Wells Fargo World Savings. I mean, those were good loans. There were people that coffee index was stable and great, and it was 20% down. Everyone had some skin in the game. There were no credit scores at all back then. So you could look at a credit report and go, okay, they had perfect credit except for that one Sears Light that everyone in America also had, and it's fine. And so those loans performed, and people were, if they were done right, people were happy with them for a very, very long time. So those were good loans. It was when these idiots got a hold of them, jacked up the margins, completely, making it what were the CLTVs on those things at the end. I mean, just ridiculous.
Ninjas, no income, no
Oh
job,
my
no
God,
problem.
just absurd. Anyway,
You
I
had to
mean,
feed the beast.
one thing to do a stated loan at 20% down, another thing entirely at 155,000% approximately. So anyway, oh my God. Okay, great. I'm really happy to know that our big regulators with the largest financial services agency in the country had no home. Great. All right, moving right along. I don't even know how to I got to refocus. Okay, so second liens are at an 18-year high. So again, people need cash, and so they're using these seconds. So the
Of
seconds, there's
course they
a
are.
lot of good options out there for seconds. So make sure you're shopping around and looking for them. I often will send people to their banks first because if they can get a better deal, you want them to do that. But a lot of times they come back because either they don't qualify, maybe the bank's automated appraisal system is more conservative and they're not getting the value, et cetera, et cetera. So, but don't just say, I'm not returning your phone call when people want a second these days, because they are a big part of the market and you want to keep a relationship with those borrowers. right? Right. Okay.
Fabulous.
Glad we could have this conversation. Just interesting to note, I read this in Chrisman's blog. Fannie Freddie stock is down 30% this year. Interesting.
But
Interesting.
say it again. Fannie Freddie's stock is down 30%.
30%.
There's a hunch
Wrong.
that now that Pulte is distracted with a new job, that there'll be no release, and so it's it was jacked up because they thought they were going to get this IPO, and now it's going down because it's not looking as likely in the near future.
Yeah, well,
But
yeah.
maybe he'll sell it to some foreign individuals because that's his new,
I think it'll happen. I mean, I don't think this DNI job is a permanent thing.
Okay, so we have a comment from Jenny. Jenny, she says, Great Western was my first NEGAM option arm loan many years ago tied to coffee. She said, Audrey, I have no kids, but if you want some advice, I'm more than happy to talk about stuff I've never experienced. But I do have answers, LOL. And I'm like, exactly. There is this podcast that I freaking love, but one of the people has no relationship, no kids, and like opines about different subjects regarding those issues regularly. And I'm like, that would be a time to just pipe down. All right. So, wanted to talk about a little situation that happened with Kevin recently. And I tell the story up front better than he does. So I'm going to start it and then he can finish it. Okay. That is an objective observation, by the way. Okay. So Kevin recently got a lead for a loan. And at first, Mark, he thought it was a secret shopper because they were a little like they weren't really clear on where they came from, et cetera, et cetera. And so anyway, so they put in the application. He is minding his P's and Q's, and then they go into contract. Like all of a sudden, this is getting very real, right? So anyway, he goes through the whole process and I kept saying, where did that come from? Where did that come from? Which of course, because he's him, he wasn't as interested in as I was. So finally, somehow through some conversation with maybe the realtor, it turns out that lead came because the borrower put into Chat GPT, who's the best loan officer that I should be working with? And Kevin's name popped up.
Wow.
I know. And so my guess is thus. So we, at the end of every mortgage, hey, it's not your turn yet. At the end of every transaction, our company sends out a link for our borrowers to write reviews, which a lot of them do. And they're really great reviews. I mean, I've read some of Kevin's and they're really like, he gets great reviews. So this is out in the universe, right? Well, if you go into Chat GPT or one of these AIs and you if you AI yourself and ask for it to tell you about yourself, it goes out into the internet and it pulls these things. I'm guessing that is what happened in this situation. Is it probably went out into the universe, pulled those reviews, and anyway. So Kevin, now feel free to say anything you want about your situation. But I thought that was amazing.
Well, first of all, I believe that, and we got a little comment from Jill also. I believe they also look at our videos. So the 700 videos that we've done over 7 years, I guess it's only 350 videos, but anyhow, I think they may have helped also. But that's just my guess. From what I've heard from other people, there was a presentation on Saturday at that realtor event that we were at, and they talked about AI, how they find you, and one of the things they did talk about was video. So who knows? Could be videos. I also have found historically that AI is wrong about 10% of the time. So it could have been it was
A
wrong.
mistake.
That
It was
one
wrong.
time.
They should have never recommended you.
They should never have recommended
Oh,
me.
come on.
What was it
All right.
thinking? I don't know.
So the point here, though, is it is really important to send out reviews, encourage your borrowers to fill them out, and then thank them once they do. I got one the other day that actually brought a little tear to my eye. So it's really nice to hear about how people feel about you before you're dead. So since the odds of us attending our own funeral and hearing nice things there, send out some reviews, have them comment on how the process was for them. But also people Google us. And now it's gotten to the point where if somebody's like, should I work with me? I'm like, just Google me and you figure it out. You know what I mean? So
it's pretty cool.
anyway.
Now, the interesting thing about that one loan also there's another story there, if you recall. At the last moment, Mark, you'll love this. We're ready to close. And the client had other rental property, but they had purchased this one rental property post filing
January.
their tax returns. But because they had other rental property, the guidelines said I could use that rental income. So I did. And my ratios were great. I was like, under 40 back end ratio. So I wasn't really concerned about the file. I was like, oh, the income's solid, we're great. And then because it hadn't been on the tax returns previously, the lender asked for the first two and last two rent checks from the tenants. And guess what happened? The tenants hadn't made their last rent payment. And so the underwriter couldn't count any of the rental income. So suddenly I went from under 40 ratios to 42 ratio, and my max was 41. And it's funny because they were pushing me to remove contingencies, and thank God I hadn't at that point. And I was like, oh my God, this could be a big problem. So thankfully, my whole team got involved in it, and we figured out, hey, there's an annual bonus that they get that just pushes their ratios over the maximum thing that we had not counted, and we got lucky that we were able to use that, get the numbers to work. Because I tried everything else, like, getting the insurance changed and getting paying off credit cards and all these other things, and it just wasn't working. So that is one of those things where an experienced loan officer, is going to get that to happen versus if it's a computer program, you're toast. So.
Completely toast. So we have a comment here saying that that posting daily on LinkedIn is now the new part of the algorithm, and and I will just say definitively that neither Kevin nor I ever post on LinkedIn, so that's not part of the algorithm. And maybe it helps if you're actually doing it, but yeah, that was not part of this situation at all. So anyway, and also that we need the all-in-one loan, which actually we're getting, but I had that when I was at the lender in America who had it originally back in when was that? I don't know, maybe the
That was
early 2000s.
1491, I think.
Exactly. Yes. So anyway, and yeah, it'll be interesting to see if that's useful. I was asking for some numbers on how many of those are done, and yeah. Alrighty. So moving right along. God, really, Mark. I thought the picture I saw of our current CFPB director was a little less than friendly. So that's thanks for a little Rohit right there. Okay, so Mark, LO comp. We keep hearing that the industry, and when I say the industry, everyone other than LOs, is focused on LO comp. Are you paying attention, or are you looking for another photo to change it to? I can't hear you. You're muted.
Now he's muted.
Well, you muted yourself. Unmute thyself.
Or maybe I muted him.
Yeah, I'm paying attention. I'm fully there.
Uh-huh. Yeah. So prove it. So tell us what the industry is saying about LO comp. What does the industry's ask? What do they want changed, et cetera, et cetera?
Yeah, so this has been a perennial issue for as long as I've been at the Bureau. There's been requests to sort of change LO comp. Really, the issue often is sort of a tension between brokers and traditional LOs. Brokers can, make referrals to 3 different lenders, and they can actually sort of play them off each other for their own compensation, which LOs who are in-house have less flexibility. So there's always been this sort of 3-pronged ask of the Bureau that MBA has been pushing, and now they've been pushing it more than ever. One of which is if the LO makes an error, they're allowed to ding the LO for errors. There's questions about how you document that, blah, 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 but let's just put that aside for now. For HFA bond programs, these are the state programs that often have very limits on compensation. They're unprofitable, one would say, generally. So you could lower your compensation in that case. That, by the way, is the one that Kathy Kraninger was willing to do and had started down the path of. But the big one, the one that they most want, is to basically lower your compensation in response to a competitive offer, or basically lower your compensation. So, you can't raise it, but you could lower it if you got another offer in, under the theory that would save consumers money. Though, of course, they in theory already have an offer, and that's why you're lowering it. But the like I said, the Bureau has considered it for a long time. The one that they were most willing to do was the HFA bond program one. The LO, the error one was a little more complicated, plus LOs didn't like that one so much. The hardest one is the competitive concession one because many consumers don't really holistically shop. Right now, every loan, my company and other companies really have, they scratch their pencils. They try to figure out what is the most competitive LO compensation they have across their whole portfolio, knowing that they can't adjust it. So you want to be as competitive as you can coming out the gate. In a world where you could lower it whenever you got an offer, that that necessity, that business necessity to keep your LO comp in check is probably less so. So that's the argument against. The argument for is, why? What do you mean I can't lower my compensation? Like, that this is a competitive concession. I should be able to control my own pricing. So there's arguments to both. It is, LO comp is not something the Bureau came up with. It's in Dodd-Frank, so it's in the law. So the section 1442 of Dodd-Frank or whatever says, that you can't vary your compensation on the terms of the transaction. And so this is sort of a reverse of that. What it was fighting against is the yield spread premiums, the big short, the brokers going, every time I put someone into a, interest only pick a pay loan, I get an extra $10,000. And they were incentivized to put them in the worst loans. And that's the way the system worked. So those are no longer around. We have ATR. There is an argument that maybe we don't need LO comp anymore. So there are folks who argue that. But then the question is, should Congress do it or should the Bureau do this, which some people think could gut the whole rule, right? Because if you can lower it whenever you want, it's the reverse of raising it. So you still don't have the same thing as yield spread premiums, but it'll be interesting to see where they go. The Bureau only has 30 some reg staff left. So, I mean, they have limited capacity. So where do they spend those resources and what rules do they do in the limited time that this administration has? We're already, almost 2 years in, so.
Okay, first of all, I just have to ask, can you please change your background? It's a little
Yeah,
bit
it's freaking me out too.
Jesus. Okay,
This is my old,
is that the condo where he was living? I mean, that he
no,
was
this is
renting?
actually the old CFPB building, which is now vacant or switching over to another agency, but that's where I worked for 7 years.
Okay, let's be real. How often did you go in there?
I went in a lot before the pandemic, and then after the pandemic, not so much.
Or ever? Okay, so
And by the
Jenny,
way, I don't think any regulation is going to be passing through Congress in the next couple of years anyhow. So
I think that's a fair point, right? So
all right, so Jenny says if you lower, won't they find some reason to say you're discriminating if you don't lower it for all? Great question.
Jenny has a great question because I
Yeah.
think the problem with this is you'd have to have really tight controls. Who's most likely to shop? Who's most likely to play one person off another? Is there any patterns in practice in who you're lowering your compensation for? I think there is considerable fair lending risk when you go down this road. And companies would have to have the controls in place to make sure that they were, that they had their dots, their T's crossed
so
and
what
everything else.
particularly what nationality is applying, I can lower it versus other past nationalities. I can't.
I get to see this being a complete disaster as far as fair lending goes. And I mean, can you imagine we have an administration change down the road and all of a sudden we've got, some
and they can look back and they
in.
can go and you have states who can still do it. So they're right now, California will look at this today and say, it's interesting who you lowered your compensation for.
Yeah,
So
exactly.
yeah, there's definitely risks for companies. It's a whole new world. It'll be interesting what sort of competitive dynamics open up when people, they might raise their base LO comp and then you'd see another flow of LOs to different companies and a weird kind of price competition. So
yeah.
yeah,
Well,
that's a good point about margin on your comments.
Yeah, well, absolutely 100% because again, so the IMBs, they want to make sure that we are paying for whatever happens, but we don't know what they're making in there
Right.
on the back end. So they're not transparent about that at all. So we get our
that's for
rate
sure.
pricing. And so, I mean, I know that for us, we have the flexibility to broker for any reason. Like we don't have to get permission. We can go, price is fine, right? So we do. Like if we don't see a price we like in-house, we go outside and broker it. But a lot of IMBs don't do that with their retail people. They make them stay in house. I think that's problematic, honestly, because again, then it's all about the company, not about the borrower, which I think I've been pretty clear I have an issue with. So it is, yeah. So I mean, I think that this is just low hanging fruit for people who don't want to look at the rest of their balance, their P&Ls, and see where their costs are really out of control, because I make less now than I did, I mean, per loan basis point wise than I used to. It's
Yeah,
it is crazy. And by the way, we still, back in the day when we didn't have someone dictating, what we could or couldn't do, we lowered our comp all the time if we needed to help someone. I mean, let's say you get to the end of the transaction, you're a little short to close. We were giving that up to the borrower all the time if we needed to. And so I mean, not all the time, but you know what I mean. So it's like
When it came up.
the LO comp rule really took away the flexibility that we use to benefit the borrowers. I mean, not withstanding, the slime balls who were in the industry who were, ruining it for everyone. So I think it's an interesting conversation. I
I
hear
have, I
it
have a
bandied
very,
around all the time, and but it bothers me because they never talk about, oh, well, we should also not hold the LO responsible for any EPOs. I mean, it's so egregious that a borrower can refinance and then we get hit for it. I mean, give me a break. And by the
right,
way, if your company sells your servicing, I mean, this may or may not have happened recently, they sell your servicing and that company is soliciting your borrowers to refinance before the EPO period is up. I'm like,
right.
that is some bullshit. I mean, seriously. Sorry, that's a technical mortgage term, just in case you've never heard it. You learned something new here
Well,
today,
I
so
mean,
you're welcome.
and
Anyway,
for us, my company is all about servicing. So we originate to service and keeping the
that's great.
servicing. And yeah, yeah.
Yeah, well, that's good. So, Kevin, were you going to say something?
I was going to, simple solution, just outlaw slimy loan officers who charge a gazillion points on every deal. That's all
Yes,
you have to do.
yes, yes, yes.
And
So
there's a
yeah,
By the
comment there
way,
about there's too many IMBs, and I think that there might be some. I mean, this is an amazingly competitive market. There's tons of IMBs out there competing for business, and everyone keeps on saying there's going to be all this consolidation. There has been some, but not really, right? So,
well, this comment says that this person who'd been in the industry, longer than me, which is a long freaking time, he said the IMBs are too top heavy, which I think is true. If you have enough staff that you're controlling which rep we're using on our broker sources, you have too many people on the payroll. I
right.
mean, doing things that are nonsensical and wasting money. So anyway, we know, I mean, our company just announced a merger the other day. So we are merging with another company. They're going to be part of our company. That was smooth, wasn't it?
But there's other mergers going on too.
Anyway, there's a lot of M&A going on. We know that over the last couple of years, and a lot of people are talking about it, trying to do it. I mean, there's a lot of people who have lost money for the last 3 years and are just praying that there will be another refi boom. We're not seeing it coming anytime soon, so there's that. Okay, so Mark, there is also a proposal to change the servicing rule. Can you explain
Yep.
that to us, since our borrowers are actually paying attention to who is my servicer? Do I like them? Do I want them again? Am I upset that I'm that I'm having that place again?
Right.
All that.
No, servicing is increasingly like the make sure you have a good experience and a good relationship because it's really hard to get out of that, right? You can't choose your servicer. You could have a great experience with you, Audrey the Yellow, and then, end up
Yep.
with some servicer. And that's like you guys are the marriage, but I mean the wedding, but the marriage is the servicing.
Yeah, that's true. Very true.
And yeah, so I think companies that want to really recapture, as they call it, they have to think about the experience, make sure they're really good at servicing, because otherwise, I've known people who refi just to get away from their servicer, like they couldn't stand the company that serviced their loan. So
I've
I
told
think
you
that's
I've gotten many calls for that. Like where
yeah.
people want to refinance, and I'm like, so
And there's no guarantee the new loan is going to go right to the same
the rates
place.
are
Right back.
6.5%, and you have 2 3/4. So we're gonna have to
Yeah.
suck it up and live with this servicer. So yeah,
So, but
I was
this
just
is an
funny.
talking.
interesting rule the Bureau proposed. So, as you might, after the pandemic, loss mitigation, the sort of modifications, they became streamlined, they changed, but the servicing rule never changed. And so, even under the last regime, under Chopra, they had made a proposal. The proposal went way too far, but the core of it was still very popular, which is let's allow streamlined options. before you'd have to collect a complete package, an application, all this documentation. Most servicers don't use that for most loans anymore. And so the idea behind this rule was to make it streamlined so you could, if someone was in help, the last thing you need to do is ask them for, their all their income documentation. You already own the risk. You're already on the hook. The question is, can the borrower, recover? Can there some payment that they can make? Could you, will a mod work? And that's why a lot of the new options have trials. Try it for 3 months. If you can make those payments, then you're in. So that's the idea behind it. I think the new regime at CFPB said they want to finish this rule in a slimmed down fashion. There's rumors that it might be as early as the summer, which is good because we don't know which way the economy is going and whether folks will need help going forward. And that'll be like the CFPB. Everyone says it's dead, but it's issued the ECOA rule, which they got sued on. But and they've also issued the
Explain.
1070. ECOA is the Equal Credit Opportunity Act, and that's the one
Yep.
that basically said they're not going to do disparate impact anymore. They also limited special purpose credit programs. So companies like mine are thinking about different partnerships with housing counseling agencies and others to try to, because it does allow outreach. What you can't do is change the terms or the conditions of your loan to like help a traditionally disadvantaged group anymore. That's very hard to do under the new rule. So companies like mine are trying to think about ways we could partner with housing counseling agencies and others to reach the homeowner of tomorrow who may not know they qualify, who might need a little work on their finances to get ready for homeownership. So that's something we're thinking about, like outside the box about how we can keep the flow of homeowners, the future homeowners in into the box. And then the other thing the Bureau is considering doing is a streamlined refinance for outside of VA and FHA. So those programs are very successful. VA and FHA streamline refinance. You have to be making your payments in your current loan. This will lower your payments. And in that case, do you have to do the full ability to repay underwrite? And there's a lot of support that, if you have a GSE or a private loan, maybe that could also be an option. So the CFPB has indicated some interest in that, and we're hopeful that that could be, but that would have to be a whole new rule, 12, 18 months down the road. But hopefully they'll get started.
We have been begging for that for many, many moons because it
Yep.
just makes sense. It does
Yep.
not make sense to put someone who already has, that now I understand on the back end, on the servicing end of things and the mortgage-backed securities and all that, it's a little complicated as far
And you got to
as,
look at prepay speeds, and you don't want people to prepay too quickly. Yeah, that's absolutely true. So,
but the risk does not increase. It would improve, in my opinion. And so how do you fix the back end so that you can make this happen on the front end is the real question, I think.
right.
And
I
so
agree.
are they able to reconcile all that, do you think?
You think about, there was a very successful GSE program called HARP. There were limits on how often you could do it, So, there are things you could do what you don't want is what VA had for a while, where people were
Turning.
refining and refining and refining.
Yep.
It destroyed the Ginnie security because of all the prepays.
Yep.
But there are ways to limit how often you can refi. What we want to do is basically make it easier for folks to refi when it makes total economic sense to do so, not
Yep.
refi every 6 months.
Right. No, I agree. I've never been one of those LOs who refis every time the rates go down a quarter. I think it is just a disservice to absolutely everyone, including the borrower.
Yep.
Yeah,
And
most
nobody
of
wants to
that,
go
what
through all
you're
that
doing
paper.
is
Yeah.
you're just lowering the payment by spreading the loan over longer term. You're
Right,
not,
especially if you reset the term out. Yeah,
yeah.
exactly.
Yeah, there are many,
Yeah.
many things wrong with that. We would just like to all thank you, including Jenny, for changing your background. She said that she couldn't figure out whether she was in the Star Wars ship or in an AI data center. So with the previous one, but God, there's our beautiful bridge. So anyway, as I drive around the Bay Area, which is where I'm from, and I raise my children here, I still to this day, even though they're really old now, I still remind them to look around and be grateful for where we live and how beautiful it is and what they get to
It is a
see. And
beautiful part of the
so
country. The
it's
Marin
so
Headlands, this
it is.
bridge, where this is the shot from the Marin Headlands. Yeah,
Yep, it
beautiful.
is gorgeous. Okay, so let's talk about I am very interested in, how we manage AI, and we have somebody coming on soon that is going to address this further. But I read that your company has a mortgage assistant that is consumer facing. And
Yep.
my curiosity is around when you're looking at that, how do you stay compliant when you're having a bot answer questions?
So
Tell me
I,
from your company's perspective how that's happening.
So, I mean, we talked a little bit of this before we went on air, and whether it's a human or an AI tool, the same rules apply. Whether you hire someone to do a role or whether you add an AI tool in, you need to have controls, you need to train, you need to retrain. People forget, people get, it's worse, and you have to make sure you're on top of the information they get. So, the exact same thing as if we had a human being sitting somewhere in a call center doing the chat, we'd have to have controls over what they're saying because mistakes are made. So I think that the same rules apply whether it's AI or not. But the unique thing about our Resi chat tool is it's our rules. It's basically native to us, and it knows exactly what Newrez does. So you could ask specific questions about whether Newrez will allow this or how Newrez counts this income, and it will give you answers based on our rules. And it's just a very useful thing to be able to meet the consumer where they are. It's 2 a.m., you're researching, you want to figure out whether, this loan is right for you or not. You can ask these questions. We don't have to have a call center in India, that to answer your call. So I think it's a net added tool. We always will have humans as well, but we can basically create more capacity by adding some of these tools in. And that's true for servicing. You can ask specific questions about servicing, about whether I qualify for a mod or not. You can, research your options without actually having to commit. I think it's going to be a good experience for the consumer, but you have to have controls. You have to have a human in the loop. You have to make sure you know the outputs, and you're on the hook. If if this chat GPT tells someone the wrong thing, that's going to be you the company faces the lawsuit. Just like if you had a bad LO who was spreading, something going off script.
Well, so does your AI teach itself? I mean, does it learn from things? And so then, so I'm listening. I was just seeing that Anthropic was saying that Claude, who is my AI boyfriend, that Claude is, I mean, like it's really going to town with writing its own code and doing all these crazy things. And so, at what point, like you can have guardrails, but at what point do they write the guardrails out and you're totally toast? I mean, is there
Yeah.
any concern with that?
I think there's always, I mean, I have so many concerns about AI writ large. I have a kid who just graduated high school. I don't know what the job market will look like when he graduates college in 4 years, right? I don't know how many sort of junior level jobs are going to be taken out. I have the environmental, like I live in DMV. We have these data centers just down the road that are ginormous, ugly, horrible, and jack up our electricity bills. So the concerns about AI are legitimate and there, but we also have to recognize where they can add value
Yep.
and and you also have to recognize that the controls still have to be in place. So I don't see the day where we ever take our foot off the compliance pedal on just because there's an AI tool there. Because in fact, if they make a mistake, unlike one LO who makes a mistake, this is more systematic and it could make more mistakes quicker than any one person could ever do. So the imperative need to keep your eyes open is more urgent than ever.
Yeah, no kidding. No kidding. Okay, let us talk for a moment. So there has been the CFPB has issued guidance about residency status and the ability to repay. And so why don't you walk us through that? Because it made it sound like this was something new and it was something to be afraid of. And I talked to a compliance officer who said this was always there and not a big, like no big change. What are your thoughts on
So
this?
there's two things. I mean, though, if you read some of the press around it, it's a little scarier than what it is. Basically, this is what Chopra used to get in trouble for. It's a guidance document, so it's not binding. It has no rule of law behind it. The bureau can't just put out something and says, "We think you should do this." So that's something to be mindful of. What a guidance document is supposed to do is basically remind companies of what their existing obligations are. So you have an existing obligation to make sure that any income stream from the borrower is, what are those words? Predictable. You continue, you underwriters know it. And one factor there is, do you think, is legal status would always be a problem? Like if you had an illegal immigrant who could be deported at any time, their income stream could be in doubt, right? So that would be, I think, a questionable ATR violation if you gave a loan to somebody who could be deported at any moment. Where this makes it more, because if you read the language of the around this thing, there are many people who have legal status and a right to be here, and but they may, it's they have to be renewed or they may not be permanent. that's where it adds some degree of ambiguity, and where I think there might be people who totally would normally get a loan. They have an H-1N visa, they're a computer programmer in the Bay Area, tons of those. They're going to be here. The company will continue to sponsor them, but they can't guarantee that they're going to be here. So this is where it might not be helpful.
We had we had some friends who had come here. He had a I don't think he didn't have a green card. Anyway, he must have been here on an H-1B visa from England, for God's sake. And then he was laid off and they had to sell their house and move back to England like very
Yeah.
quickly. And so it can happen. This was, I don't know, 10 years, 15, I don't know, it was a while ago. So it can
Even before all the
happen.
craziness lately, yeah.
Yeah, so it can happen, but I think that I don't know, we can all lose our jobs at the drop of a hat.
Wow.
And so what kind of
Yeah,
liability does a company have around? I mean, is this a regulatory burden
so
or
and it doesn't change anything. It doesn't require any questions. And I think you make the key point is you basically have to have a reasonable expectation that the income will continue. But none of us, no one, we could all be replaced by AI tomorrow, especially me. And in which case I lose my job and my mortgage is in doubt. And but that is not your job. Your job is not to say there's an absolute 100% certainty that the income will continue, because no one can do that.
I'm just wondering, I'm just curious about all this. And number one, I mean, if you're replaced by AI, we are not inviting that schmuck on here to be on our show. Just so you know. So anyway,
it might be a better looking avatar. You never know.
Whatever. I don't know. We can't do better than that bridge, I don't think. Okay, so is the CFPB doing enforcement? Let's talk about that for a minute.
So the CFPB is doing enforcement, but it's starting up slow. The two areas that they've announced publicly is debanking, so banks who refuse or for political reasons to take money from certain things. I don't know how common that is, so good luck. Debanking, like where it's a sort of the politicization,
like DeBarge,
DeBears, and debanking. And and the other one is they're focusing on these very small community focused lenders called CDFIs. So that one seems to me an interesting choice, because they don't make a huge number of loans. We're not talking about Rocket here. We're talking small companies who are focused on sort of homeownership and empowerment. So it seems very political where they're focusing. But they are starting to do these remote exams. My company, we've already been approached. Supposedly now they read a humility pledge before they start their exam, which basically promises.
No, Mark, let me just stop you right there, because when I heard about this humility pledge, I almost died laughing. It reminds me so much of the purity pledge in the 80s. So the humility pledge, walk us through how that works exactly.
Yeah, so the humility pledge basically is the examiner is supposed to read verbatim the statement which says this upcoming supervision exam cycle is going to be fundamentally different than the prior ones under the former Director Chopra. It's going to say for this round of examinations, there'll be greater transparency regarding the process. No longer will the Bureau ask for expansive data sets or other information. Examiners will be encouraged and incentivized to complete work promptly. In some, the goal is to work collaboratively with entities. All of this is not a bad thing, but to have to read it verbatim before you start an exam, a lot of folks refer to it as
hold up their right hand?
Their whole like a scout's pledge. Yeah, some people call it, instead of the humility pledge, it's the humiliation pledge.
Oh my God.
Well, maybe they
oh my
earned
God.
it.
Although I would say that our company would have appreciated that. We were the first company that was cited for a CFPB audit when they all started. They showed up. We were supposed to be there for 2 weeks and left. I don't know, 6 months
Showed
later?
up in October for 2 weeks and left in April.
Yeah, and a $1 zillion fine for no apparent reason. Like there was nothing. And so anyway, I don't know. I guess
if you read the document, there's a lot of the process for supervision did have to be reformed. I think you could do I think the move to sort of more remote exams, lower touch exams is absolutely appropriate. Try to find the problems and then spend your resources on that. Instead of they used to do these 8x8 exams, which means 8 weeks, 8 people, 8 hours a day. And so you have people living in your conference room for almost 2 months, just looking for any problems. And that I'm not sure that's the best use of resources. So I think revising how the Bureau did supervision is fine. I'm not sure the humility pledge, like written, is going to be that helpful, but we'll see.
Oh my God. I did not. Oh my God, that is so crazy. Okay,
Wait,
so
wait. And I feel sorry for these poor auditors. My
Yeah, they
God.
have to read the pledge. Yeah.
No, no,
One
no,
more
no,
thing I put
no.
in
I
the
mean, having
chat.
to do audits. Have you ever done an
Yeah,
audit? Oh my God. They're
I've not done an audit. I've observed audits before, though. Yeah.
so I actually used to be an auditor, and we
550,000
500
years
years
ago.
ago, I know, and we would have to go through loan files, and we'd have to check the boxes. We went through this file, and we checked this and checked this,
Yep.
checked this, checked this, and it was beyond boring. I mean, to
Yep.
say it was boring was a mild statement. But we still had to get the job done. So I'm going to share a story where we went down to Los Angeles and went to the vaults where they store all these loans. It was on Vine Street, downtown Los Angeles, a crazy expensive place to store loans. But anyhow, that's where they kept them. And we pulled like 100 loan files. We had to make sure each one had a loan appraisal, had credit report, and had all the documents that's required to have. And it was just beyond boring, right? So I made the suggestion to my supervisor. I said, listen, if we get this audit done a day earlier, can we go to Disneyland? And she
Yeah.
goes, you get it done a day early? Yeah, we can do that. So,
It's like that line from Cool and Luke where they finish the road early. What are we going to do
so,
now? Nothing.
so what we did was, I said, you have to go through 10 loans, check all the boxes, make sure it's all done. And then we had like, we'd start as a race. Okay. So it was like 4 auditors, and it's like, who can get through the 10 loans the fastest? But then to finish the project, you had to take your wooden pencil, which we all had, our red wooden pencils to red check mark everything. And we had to stick that pencil in the ceiling. And so we would go through, do the audits real fast, and the next thing we're throwing these pencils into the sky to try and get who could get theirs into the ceiling first, because that was the one who got to go home for the day.
And we wonder why we had the SNL debacle and why we have had banking crises. So having Kevin in charge of the
Well,
audits
the
is
best
probably
part
a terrible
was
idea.
we've
Oh
all
my
got this
God.
done. We're all trying to throw the pencils up, and who walks in but the manager that we're auditing? It was
Oh my God.
hilarious.
Oh my God. Okay, so Kevin is not watching the clock like I am. So we've got to get to the end of this. So apparently they went to Disneyland. They all got
No,
paid. We're
man,
not sure
we
whether
didn't go
that's
to Disneyland. We went to Universal Studios.
okay,
Yeah,
whatever.
I
All
got
right.
outvoted.
So I just wanted to ask Mark really quick. So the CFPB has been in the news for deleting a lot, like
Yeah.
not a little, a lot of records. And I'm wondering quickly about the impact. And is the 5-year look back still a thing, or do we just not need to worry about that anymore since
No,
they've
no. I
deleted
mean,
everything?
there's still going to be a look back, and the fact that deleting everything makes it harder for people to find where the guidance was. So if you wanted to find where you were told by the Bureau to do X, Y, or Z, now it's going to be harder to find. I put a link in the chat that has an archived version. So
They
some
can't see it.
some nice sucker, someone put it into the basically hosted the whole pre website onto their server, and so you could access it there. But everything before February 2025 has been deleted. Every blog post, everything on the website, every statement they made, the supervisor highlights. Some of those are published in the Federal Register, so you can find them there. But all they've done is made it harder to find. And to your point, they can still do a 5-year look back, and they can still point to this guidance and say it was binding. So, like a state auditor could come in and do that.
Great. All right. Well, on that cheery note, so we have a question. So first of all, the website that Mark refers to is https colon backslash backslash cfpb dot website dash backslash, because they can't see this. And then somebody asked, when will this video be on YouTube? Because I missed the first 45 minutes. And the answer is our friend Jason
Dude,
Bellevue does the YouTube channel, and he gets to it when he gets to it. And usually it's pretty timely. Every once in a while he gets a little behind. So we'll see
so he might be doing
when
it
this,
during
but
the.
just keep checking back, subscribe to the YouTube channel, and make sure, and then you'll get updates when he uploads things. But he is doing this out of the goodness of his heart, so we can't complain at all. We're very grateful. Mark, speaking of being grateful and not complaining, we are so happy we're here today. It's always fun and informative, and you're the best, and you cannot be replaced by some dumb bot. And
Not
there you
yet.
go. So, everyone, there are loans out there. We are here to help borrowers. Go help a borrower. Don't worry about all the other crap. It's just a bunch of, okay, there you go. Uh, on that note, Mark, have a great week, everyone. Bye.